September 25th, 2023. This was essentially a wedge. So we got one push down, two pushes down, three pushes down, and it was a wedge pullback of the opening spike. And we got basically a measured move up of that wedge pullback. We get measured moves of bull flags pretty often, whether the breakout's to the upside, you get a measured move up of the bull flag, or if we had ended up breaking out to the downside, say 18 got more follow through, you might get a measured move down with the bull flag. Big gap down on the day, not all that big, but a sizable gap down on the day, and a strong bear bar on bar one. But bar one probably won't have very much follow through. There's big tails on both sides. It's more likely that we're going to get back to yesterday's low. I always pay a lot of attention to the prior day's low whenever there's a gap down, because if we're able to get back to the prior day's low, then limit order bulls who got below the prior day's low will be able to make money. So it's not as strong for the bears. We got follow through, or we got a bull bar on bar two, and it's an inside bull bar. And inside bars can be opening swings pretty often. You can see we got an inside bar as the opening swing here, another one here. This was an inside pattern, inside bar here. So we got a lot of inside bar opening swings. And then we have today's, and a lot of times they end up being the low of the day. So it's pretty reasonable to buy above two, hoping that it's the low of the day. And you can see that it basically was. You had to sit through a pretty deep pullback, but that can be pretty common if you're buying, looking for the day to be essentially the low. Follow through on three, good for the bulls. You can see that if you bought above the high of bar two, your entry price was 43.50, and we got up to 43.55.5 before we sold off. Why did we sell off at that price? Because bulls got 5 points. So bulls who bought above two made a minimum scalp, which is 5 points currently on bar three. And generally, when you make a minimum, or when traders make a minimum scalp, that's when you start to see selling. At 40% of an average day's range is generally what you would consider a minimum swing trade, and 10 to 20% is what you would consider a scalp. It's a little bit flexible. So with the I don't know what today's range was. I haven't looked. 38, but around 40. So you assume a little more than 15%, something like 5 points. And you like to use, as whole, 4.5 points, you wouldn't want to use something like that. You want to use whole numbers like five, and 5 points is generally what a scalp is. And so bulls make a minimum scalp on bar three, and we find sellers. And you can see on bar four, we get up basically right to yesterday's low and start to sell off. And that's why we start to find some profit taking there. It's not surprising that, that happened. That pretty much always happens when you get to big resistance like that. Bulls who bought during 2 or 3 or 4 are going to be a bit concerned that we're going to start to sell off, and so they'll just start trailing their stop one tick below every bar. You think about it, how often does 2 through 6 just lead to a really strong bull trend immediately? Not very often. So traders are expecting a deep pullback, so traders will be willing to get out below a bar like 6 and look to buy again lower on a wedge pullback or something. And you can see on bar 7, we pulled back below bar 6, which is where a lot of bull stops got run, and that's why we got some follow through on 8. Second leg up for the bulls on 9, and you can see 10 essentially test the 6 close where bulls were buying, in the first place, and that's why we find sellers there. 10 is a double top. You could call it a wedge if you wanted to. 1, 2, pull back 3. But I think it's better to just stay out. Some traders will sell below 10, but the problem is the moment you get back to the one high, you're probably going to find a lot of buyers. Anyone selling below 10 knows that the bears who sold above 1 are disappointed, and they're probably going to scalp out when we get back to the one high. You can see they never had a chance to get out on a 4, so they're currently trapped. So my problem with 10 is your risk reward isn't all that great, and it's a pretty low probability trade. You get some follow through on 11 and 12. But is 11 really ideal follow through for the bears if you sell below 10? Not really. You want a really strong bear bar closing, maybe somewhere down here, or maybe, ideally below the one high. And at least you wanted it closing below 7, since 7 was the first breakout point. It's a neckline of the double top with 7 and 10. So I meant bar 8. You want it closing below bar 8 at least, because that's the neckline of the double top with 7 and 10. And you don't even get that. And then 12 was on its low, but you can see it got bought back up, and it's just a really disappointing bar in general here. And so with all the disappointment on 12, bears will buy back their shorts at at the market, just trying to get out. And that's what causes a big bar like bar 13. Bad follow through for the bulls who bought the close of 13 on 14, so they sell out during 15, but that 13 and 14 is strong enough for a second leg. So that's what 16 is, that bull second leg. Some bulls will buy below 16, and 17 is not ideal, Bulls were hoping for some sort of wedge setup, so they knew it might pull back, but this is stronger than you want. And it's a swing short, selling below 17, low probability of a break below the bull flag and a swing down. You are selling a third push in what's probably a trading range, so you have to be careful with that. Especially with 18, it's not quite as big as you want. I think it's acceptable because it's close below 12, but you got to be really fast to get out, like above 19. And so if you sold below 17 or 18, you can see once you got 19, all those bears thought their premise was no longer valid because they were hoping that we were going to sell off into a strong bear trend day. And if that's going to happen, you're probably going to get to at least a new low without slowing down, and especially without a big bull bar or a bull bar closing near its high. And so those traders start exiting above 19. So anyone who sold 17, 18 is exiting above 19. And that's why we get a big bull bar on 20. 20 is an okay buy. You got to keep in mind there's a 90% chance that we break out of the opening 18 bar range every single day. And so when you're up here, we're probably going to at least here. So if you're long here, you can see what we get at the breakout. And you get a pause bar on 21. Then you get big bull follow through on 22. And pretty much any bull who bought the close of 20 is able to make 10 points on 22. So, a lot of them will start to scalp out. But immediately you got to be thinking when you see 22, bears who sold above 6 are now trapped. So are they going to be let out at break even? And you can see we got bad follow through on 23 and a bear bar closing near its low on 24. But bulls bought the close, trying not to let those bears out at break even instead of bears selling the close and us getting down there. And so we got a bull bar on 25, but bad follow through on the high 1 on 26 and a high 2 at 27 that broke out to a new high. Some traders might buy the new high, but it's probably not going all that much higher. You can use the breakout points. You can see essentially 6 up to 22 was about 7 points. And then this to this was 2.25. And then here to here was 3.75. So you can see it got climactic. I don't know if those are the exact numbers. I looked at it earlier. Yeah, 3.75. Yeah, those are right. So anyways, you get a breakout on 27, but I'm not sure how far it's going to go. But you can't ignore the fact that this gap is open. So it's okay to buy the breakout if you're willing to sit through a pullback. And we do get that two-legged pullback. So some traders, they see 27, bears will sell at the market, trying to get the market back below the 22 high, and they succeeded. 28, you can see test the close of 27. So any bulls who bought the close of 27 were disappointed in 28, exiting at break even during 29. And 30 and 31 are second leg down for bears. 32 is an inside bar, or not quite an inside bar. It's a high 2, not all that great. 33 is some follow through. So, some bulls buy. It's kind of a high 1. You see on a lower time frame, you get a bull bar, and then it pulls back, and then you get a second attempt. So it's kind of a high 1. And you get good follow through on 34 and 35. But this is pretty climactic. It's a spike 19 to 22, and then a channel, basically 23 to 37. So spike and then channel, which essentially ends up being 3 pushes. First here, second 27, and the third is here. I think always in bulls are going to exit below 37. It's a third reversal. It's a nested wedge. So I would just exit and, look to buy again lower. Bulls exiting is why 38 is so big. And you can see traders, if they sold below 37, you get a big profit on 38. And they know that most of the traders selling below here is just bulls taking profits. So not a lot of traders selling the close at 38, rather a lot of traders scalping out on the close of 38. And there's no bulls left to sell. So that's why you get bad follow through on 39. You get a second leg down on 40 and 41. I probably wouldn't sell below 40. We're probably getting back to the 39 low. And if you did sell below 40, you kind of felt lucky when 41 gave you a quick 5 points. And so a lot of those traders just took it. You can see the low of this is 68.25. So it needed to get to 62.75. And that's exactly where it got to. So those traders made exactly 5 points. Inside bar on 42. I wouldn't do anything here. It's potentially a high 2 forming, but this is too steep to want to buy just yet. But we are forming an upper trading range here. You can see, loosely the 25 low is the bottom of the trading range, but that it might break through that and end up somewhere in here. And you can see 41 also closed the gap with the 6 high. That's really important too, because you knew there would be buyers there. So really fortunate to make a quick 5 points on 40 and just take your profits. You get an inside pattern, breakout mode, 50% chance the first breakout fails, and you get big follow through 44, 45, but it might just be a vacuum test of the 36 low. And you can see inside bar on 46. Keeping in mind that, break-even logic can be applied up here too, because traders who bought the close of 35 or disappointed in 36 and had a chance to get out on the tail of 37, you can see they took it, and that's what caused the bar to close on its low. So 35 is not necessarily a, as credible of a magnet anymore. So we don't necessarily have to test up here. 46 inside bar, probably buyers below, but the pullback could be deep. You can see we got big follow through on 47 and 48. And trading ranges love to run, bad stops. And so any bulls who ended up buying like the high one or something, you can see their stop got run below 48. And, if you bought for any reason in here, your stop needs to be below here, not below here. And, realistically, there are probably buyers below 41 too. So inside bar 49, probably not a great buy. 44 and 45 is strong enough for a second leg, but this is too. So it's probably just big up, big down, expecting confusion. Bad follow through on 50, but you can expect bad follow through on, anyone buying above 50 because this is strong enough for a second leg. And we essentially got a wedge pullback on 52. Some traders might sell below the inside bar on 51, but they know it's probably not going to go that far. And if it is, I would rather just wait for another strong bear bar closing near slow down here to sell for a swing. Good bull bar on 52. It's reasonably possible we get a swing up. You have three legs down. So remember how I said 1, 2, 3, spike and channel. And now it's 1, 2, 3. So it's 3 pushes down to 52. And you can buy above it for a swing. You get okay follow through on 53, but it's up and down and then back up. So you got to keep in mind this is a nested second leg. So you got to be careful with 54 and 55. As we might be getting towards the top of the trading range. And this might just be a vacuum test of the 45 close, which it turns out, you can see that's exactly what it was. Anyone who was buying in here was hoping we got a swing up and maybe, a measure move up of the bull flag. But what ended up happening was we got an attempt at a swing up, some traders buying here, and then disappointed. They sold out around break even, and that caused 56. And any bulls who were long in here were hoping we were going to rally straight up. So 56 makes their premise no longer valid. A lot of traders exit below 56. So likely to get at least 2 small legs down, which is what happened exactly on 57, pullback 58. Sorry, 57, pullback 58, and then bear bar 59 to the bottom of the trading range. It's 2 legs down. I was in general pretty bullish right now. Bulls have been trying to get breakouts. You can see we got this, and so you got to be wondering if we're going to get maybe a measured move up somewhere up here. We had this, good attempts at buying pressure, good attempt at buying pressure, good attempt at buying pressure. And so I thought it was more likely we got a bull breakout than a bear breakout. So I was looking for a swing buy. And if 61 had closed on its high, and maybe if it had been an inside bar, but mainly if it had just closed on its high, I think it's a good buy. If it had closed as an inside bar, it's an inside pattern. So 60 is an inside bar, 61 is an inside bar. So if 61 closes on its high as an inside bar, it's a great buy. But you can see it wasn't able to do that. And so traders were disappointed, and not as many traders bought above 61. And the traders who did buy above 61 took the quick scalp because they were disappointed. They thought that, this was going to close really strong and we were going to get a lot of swing traders buying. But instead, it looked like it was just going to end up being essentially a vacuum test of the 55 close, 55 high area. I don't even think, bulls weren't even able to make 5 points. So disappointed. Maybe it was a trap. 69.5 needs to get to 74. So it wasn't even quite a 21 tick trap, which means that it went 21 out of the 22 ticks necessary to get a 5-point scalp, but it didn't do that. So disappointment, traders selling out. You get 63, inside bar 64, but not closing on its low. Some traders might sell, but it's low probability. At this point, I think that was pretty much the bulls' chance at 61 to get a rally. If they were going to get it, this would have been a better bar. And not being able to get it, I don't think it benefits bulls anymore to go sideways because it seems like this is losing its influence with time. And so its influence is almost completely gone by the bar 61. That was 38 bars ago. And you could argue the trading range started here, which was about 26 bars ago. So, this has already lost almost all of its influence. And this is basically their last attempt. And when it fails, you start to get a breakout on 66 and 67. When you get a breakout of a trading range, you could argue this is the trading range, or you could argue just this is the trading range. Either way, you're getting a breakout of the trading range on 67. It's a big bar with a big tail on the bottom, and you have to keep in mind that when you get a breakout of a trading range, 50% chance that the breakout fails. And when you see this, none of this is quite as good as you want it to be. You want 64 to close on its low. It doesn't. You want 65 to close on its low. It doesn't. 66 closes on its low, maybe you can sell for a swing short, but it closes. It doesn't even quite break out of 60. It just doesn't. 67 gets too big and has tails on both sides. And so when you see this, it represents uncertainty in the market. When you have uncertainty in the market, a lot of traders are just going to, take pretty much any profit they can get. And you can see once we get follow through on 68, you get a strong surprise on 69, which is pretty common, especially, when it's not quite as good as you want. It's pretty common to get a trap. And that's basically what 69 was. 69 was a trap, trapping in all of these bulls. And so bears are buying back, trapping in all these bears. And so bears are aggressively buying back shorts above 69. Bulls are buying at the market, hoping we go higher. And they were able to make pretty quick 10 points. They had to get to 72. It's the high, 62. So they'd get to 72. Oh, I'm sorry. They did not quite make 10 points. I thought they did for some reason. But either way, we got up to the top of the trading range. Bad follow through for the bulls from 670 because it's climactic on 71. 72 tried to test the 68 high, was not able to. That's an open gap, which we might have to fill later tomorrow. This was 1, 2, 3 pushes into the close. 73 and 74, good follow through for the bulls. It's 2 legs up, but I think we're just going to be pretty sideways, and we ended up getting a surprise on 78. It was a broad bull channel today. Overall, it wasn't perfect, but we don't even need the line. It's a higher low, a higher low, a higher low, a higher high. So when you get higher lows and higher highs trending, essentially, it makes sense to call it a channel day. You can call it a trading range if you want to. You trade in the same way. You buy low, you sell high. For always in, it was probably always in on the close of 2, definitely by the close of 3. It was probably always in it was probably always in short on the gap, but probably always in long above 2, and definitely by the close of 3. Bulls probably exit below 10 at the latest, probably always in short. And then I would say always in bears exit above 19, always in bulls by the close of 20. It's clearly always in long. It was pretty clearly always in long up through here. Always in bulls exit below 37. Bears maybe sell the close of 38. I don't think it quite became always in long here. I think bulls needed one more bar. So probably always in short until 52. Probably always in long. I think on 50, 54 makes sense for it to quickly go always in long there. But disappointing follow through. Bulls exit below 56, and it's messy in here. It's hard to tell, but became clearly always in short down here. But you got to keep in mind in a trading range, sometimes where the market goes always in short is exactly where you want to be buying. So not surprising, we got a trap there. For stop order trades, I thought 2 was fine, 3 was fine. 10, if you're going to sell it, you need to be really quick to make decisions because there can be a pretty good bull war there sometimes. You could maybe sell in here, but you got to be quick to get out above 19. 20's fine. Man, 19's probably fine. It's just hard to want to buy after the pair of bull bars or bear bars. Same way, it's hard to want to buy 69 after this many bear bars. It's probably okay to do, but it just goes against what you usually do, and so it's hard to make that decision. Probably okay to sell. Probably okay to sell 56, to be honest, but disappointing follow through 57. Definitely okay to buy 52. And yeah, that's pretty much it. On the daily chart, just gonna use SPY. On the daily chart, bad follow through for the bears, kind of expected. We're probably going to get a minor reversal and some sort of pullback. I think tomorrow I would pay attention to this low. I think that it's going to be important. I'll just look at the E-mini price. It's different on the E-mini. Yeah. Well, that's trading for you. But regardless, I think we're going to bounce for a couple legs sideways and maybe try to close the gap with September 20th low. That'll be an important gap to try and close, but I think we'll get a couple legs sideways to up before we continue down. It could be, like I mentioned, a broader bear channel. And yeah, that's the day.